Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's what every borrower in Australia wants to know. When will interest rates start rising? For the last few years, it's been a very good time to be a borrower in Australia, but will that keep going? It's not just a record low interest rate, it's also the amount of competition in the lending market. One of our supporters here at Fear and Greed is Pepper Money. Over the last 20 years, we've witnessed the rise of non-bank lending, and Pepper Money is one of the original groups providing more competition and access to funding. Barry Saoud is the General Manager of Mortgage and Commercial Lending at Pepper Money. Barry, welcome to Fear and Greed.
Thanks, Sean. Glad to be here.
How do you characterise the last 18 months or so? Pretty crazy.
Yeah, you're absolutely right, Sean. It has been a very turbulent sort of 18 months, whether it's COVID, you've got the Ukraine current crisis, you've got the flooding. So it has been a very difficult time for both the general markets, but also the home mortgages as well as sort of the borrowers as well.
So how do you see it playing out over the next 12 months or so, the property market? We've seen these extraordinary increases in prices, not just in capital cities, but regional areas as well. What do you think will happen over the next 12 months? Surely that can't continue.
Yeah, I would agree with you. I don't suspect that the property prices will continue at the rate of growth that it has been. You've seen over the last 2 years sort of property growth in certain capital cities reach north of 30 to 40%. What I do expect and what the forecast is that we expect to see a slight increase. There will be probably a 5 to 6% increase in property prices this year. And I think you're more focused on the flight to quality properties, and there'll be an increase on those emphasis on those livability properties. But I expect that there will start to be a drop and a correction towards the back half of this year and next year. People are predicting a drop of about 5 to 10 to sometimes 15%. And I think that's all. There's that inverse correlation between interest rates rising and the drop in property prices, which I suspect that there will be that correction at the back half of this year.
Okay, so is that on the back of higher interest rates?
Yes, I definitely think it will be on the back of higher interest rates. I suspect that there will be, not only with the rise in interest rates, that inverse correlation. I do expect that housing prices with the demand will start to drop. And as the time in terms of immigration starts to open up, I expect that there will start to be an increase in the demand, but I don't see that in the short term.
Okay, now one of the key areas for Pepper Money is home loans for underserved customer segments. Who are those customers?
Yeah, it's a great question, and it's something that who is the underserved and what does it mean? But for us, what it means is that we like to lend across a broad range of customer sets. It's where the traditional banks don't generally serve those customers, and they are your self-employed, your contractors, your casual employees, or those customers that may have missed a default on the home loan because of a life event, and that could be illness, sickness, it could be divorce. So it really is a broad range of set of customers that don't fit the mold of your traditional banking lending criteria, and it's where we at Pepper really try and focus and really believe that everyone deserves home ownership and the right to an entitlement to a mortgage.
Okay, that's a massive group of people, I suspect. And when we talk about the banks, we talk about serviceability buffers and capital requirements and things like that. Is it the fact that Pepper Money isn't actually an authorised deposit-taking institution, isn't a bank? It has greater flexibility in those sorts of areas that enables it to provide these loans?
No, not necessarily. I think the question where we as a non-bank and a leading non-bank in this space, it's all our loans are underwritten by the responsible lending requirements and we are regulated by ASIC. So the difference is that our funding doesn't come from the traditional deposits of banks. Where we believe we make a difference is we're willing to price for that risk, where your ordinary consumer, where they go to a bank, there is that cookie cutter approach. So our ability to individual look at borrower's circumstance really sets us apart. And that's where effectively we're able to lend based on the individual circumstances of that borrower.
Okay. And then your money then comes through the residential mortgage-backed securities market?
Yeah, that's correct.
Which it seems is opening up again, because that was had been closed for a while, though I just saw figures recently that investors are increasingly happy to provide or trust people like Pepper Money and buy those resi-backed mortgage securities, which is a good thing for you guys, presumably.
Yeah, that's absolutely right. I think we at Pepper Money have got a 21-year sort of proven track record of operating in this space, and that's through a range of market cycles. So we get our funding and access our funding through that RMBS program, and the investors are confident in what we do and how we do it, and also have confidence in that whole non-bank sector.
Yeah, okay. It's an incredibly competitive sector, though. I mean, has it ever been this competitive?
You're absolutely right. It is a very competitive sector at the moment. You've got new sort of non-banks entering into the market. You've got fintechs. So it's probably the rise in competition has definitely intensified over the last number of years. But I think it's a great thing. The fact that we've got more competition, whether it's from your non-banks, your credit unions, your fintechs, it only serves to increase in your product innovation, providing a better customer experience or a broker experience. So It only leads to positive signs for the economy as a whole, but more importantly, the borrower.
Yeah, absolutely. I think the customer is the person who wins out in all this. Stay with me, Barry. We'll be back in a minute. I'm speaking to Barry Saoud, General Manager of Mortgage and Commercial Lending at Pepper Money. I just want to ask you about first home buyers. It seems pretty tough to get into the market if for no other reason than you need a massive deposit to actually pay the price of some of the homes that are going up at the moment. What are you seeing in that first home buyer market? And then from that, I wouldn't mind talking about mortgage insurance.
Yeah, great. It's a great question, and it's something that's very topical, no doubt, at the moment, given housing affordability, particularly in the capital cities, can be a barrier to entry for your first home buyer. So we are seeing that it's very difficult for your ordinary borrower and in particular your first home buyer to crack the market where they don't have the necessary deposit savings. We're supportive of there's some recent New South Wales government and Victorian government schemes around a government contribution for the house deposit in return for some equity in the property. We're also seeing some lenders try and innovate in this space, whether it's a shared equity product loan. We at Pepper are really supportive of that first home buyer market. We've introduced a product where up to 85% no LMI. So it's really great that lenders are trying to respond and come up with product innovation to really try and solve this housing affordability crisis and give that first home buyer that opportunity to get into this competitive property market.
Okay, and you mentioned the acronym LMI, which is Lenders Mortgage Insurance. Is that something that people are using more and more because they can't get to the 85% in your case, but 80% in many other cases, they just don't have a big enough deposit?
Yes, that's absolutely right. LMI, or Lenders Mortgage Insurance, it's paid to the lenders to give them security on that borrowing profile. We are seeing an increase in loans taken above 80% or 85% of the property value. It's a good option for borrowers that are trying to get into the market, and it absolutely supports the first home buyer to enter into the market where they don't have the ability to raise that deposit in the short term.
Okay. Now, Barry, you also oversee commercial lending at Pepper. What's that market looking like?
Yeah, and that commercial lending market is a growing market. We are seeing business confidence grow, and that's on the back of the impact of COVID. And what we have seen is that traditional borrower profile has changed. So as a consequence, we are seeing an increase in your self-employed. We are seeing an increase in commercial investors trying to buy commercial properties. So we expect that confidence will continue. There may be a bit of dampening with the global conditions and the recent devastating funds, but we expect that the commercial lending market will continue to grow, and it provides a great opportunity for small to medium-sized enterprise to get into the market with a lending product that's flexible and able fast to enable them to access, whether it's there to buy a commercial property or an industrial site, or alternatively a retail site. And what we are seeing is your typical mum and dad borrower, and whether that's through a self-managed super fund or whether they just want to try a different type of market, we are seeing an increase in that commercial lending space.
Are people in commercial lending more likely to look for better deals? I mean, I think of the mortgage market, and it's relatively difficult to move your mortgage. It's probably easier now than it was 2 or 3 years ago, to be honest. But with these great deals from different organisations, it's well worth looking around and shopping around and getting the best deal for you. I'm just wondering if that's the same in commercial lending. Do SMEs change their lenders very often?
Not as much as your traditional mortgage market, but the appetite of SMEs is, and their quite clear focus is all around that credit certainty and a fast credit decisioning. So that particular profile of an SME market is different. And lenders are really trying to evolve and innovate in this space to really address the needs of that SME market. So we are seeing a diverse product range. We are seeing changes in the way in which we distribute that credit. But it's an interesting market that the needs of that SME are very different to your ordinary consumer on your mortgage side. And we at Pepper Money in particular are really focused on really trying to address those. And most importantly for those borrowers in that SME market is around providing a market-leading turnaround time, understanding who that SME is, understanding their balance sheet and profitability, and really provide a tailored product to suit their needs.
Barry, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Barry Saoud, General Manager of Mortgage and Commercial Lending at Pepper Money. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.